This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Thursday, July 23, 2026, and this is the New York session. Now, let's get into it. The Fear and Greed Index is flashing a stark 14 out of 100, painting a picture of deep structural anxiety even as the VIX remains oddly contained at 17.05. We are witnessing a classic flight to quality, where the US dollar and gold are absorbing capital from riskier assets, driven by a labor market that refuses to cool and central banks stuck in a divergence trap. Looking ahead to the immediate horizon, the calendar is notably quiet on the data front. There are no major U.S. economic releases scheduled for the next 48 hours. However, two central bank decisions loom large on the edge of our radar. First, the Federal Reserve's FOMC meeting on Wednesday, July 29th, where we expect a rate hold, but are watching the dot plot for any hawkish surprises regarding the 30-14% core PCE. Second, the Bank of Japan's rate decision on Thursday, July 30th, which carries immense weight for the dollar-yen flow dynamics we discussed earlier. Apex, what is the market whispering regarding these meetings?
The market isn't whispering, it's positioning defensively. The absence of fresh US data means all eyes are on the Fed's tone to confirm whether the 3.46% CPI print was a peak or a plateau. Simultaneously, the BOJ decision on July 30th is the only variable that can disrupt the current dollar-yen equilibrium. Until then, the narrative is locked into a wait-and-see mode, reinforcing the safe haven bias.
Let's ground ourselves in the current snapshot. As of 9:32 Eastern Time, the dollar is broadly stronger, with the trade-weighted dollar index up 0.2% to 120.53. Gold sits at 4,124.62, holding firm in the upper quartile of its 5-day range. Meanwhile, risk assets are struggling, equities are under pressure, and the Fear and Greed Index confirms a fearful state. Within the Forex matrix, we see mixed signals. Aussie dollar is up by 41 basis points to 701.820, while dollar Swiss is down 11 basis points to 81.3340. Pulse, how do you read this macro split?
It's a story of divergent realities. On one side, you have the United States with a labor market showing resilience. Initial jobless claims dropped to 187,000 against an expected 212,000, and sticky inflation at 3.46%. On the other, the Eurozone, where the ECB just held rates steady at 2.25%, with President Lagarde noting some improvement in economic activity. This policy gap, combined with the flat 10-year minus 2-year yield curve at plus 0.36 percentage points, creates a perfect storm for dollar strength. Investors aren't just buying the dollar, they're fleeing the uncertainty elsewhere.
Several headlines are actively shaping this risk-off environment. Let's break them down. First, a geopolitical flashpoint. Former President Trump stated he would hold Iran responsible for Houthis attacks. How does this affect the FX desk?
It reinforces the safe haven bid. Geopolitical uncertainty is the fastest route to the gold and dollar bid. When narratives involving Iran and the Middle East escalate, capital doesn't wait for data. It moves immediately into the perceived safety of the greenback and bullion, pushing gold toward those 5-day highs.
Second, a key economic release. U.S. initial jobless claims came in at 187,000, beating the consensus forecast of 212,000. CIPHER, what does this beat signal for the positioning desks?
It validates the long dollar trades. That 187,000 figure is significantly better than the 212,000 expectation, providing the fuel for leveraged funds to increase their net long DXY positions by 4,438 contracts this week. It tells us that speculative money sees the U.S. labor market as robust enough to sustain higher rates for longer, which directly supports the dollar against softer economies.
Third, the ECB's latest statement. They kept rates unchanged at 2.25%, aligning with expectations, but Lagarde's commentary suggested improvement. Why hasn't the euro rallied?
Because improvement in the Eurozone is relative, and the Fed's stickiness in inflation is absolute. The ECB is holding steady at 2.25%, while the Fed sits at 3.63%. That nearly 200 basis point spread is too wide for the euro to break out against the dollar unless the Fed starts cutting, which current CPI data suggests they won't anytime soon. The ECB's wait-and-see stance simply removes the euro as a viable alternative to the dollar in this risk-off environment.
Finally, we have the headline regarding U.S. stock pressure continuing in pre-market trading. SPECTER, with the VIX at 17.05, is this volatility suppressing or hiding risk?
It's hiding risk. The VIX dropping 1.60 to 17.05, while sitting in the lower half of its 15.64 to 19.50 range, contradicts the fear and greed index at 14 out of 100. This dissonance suggests that while option premiums are cheap, the underlying sentiment is fracturing. We aren't seeing a crash yet, but we are seeing a slow bleed where risk assets like Aussie and Canadian dollar are being dumped quietly because investors are afraid to pay up for protection, yet still refuse to hold risky exposure.
Let's dive into the specifics. Our first focal point is the dollar-yen. It's trading at 163.042, just shy of its 5-day high of 163.23950. The pair is essentially compressed between its daily low and its recent extreme. Grid, what do the charts tell us right now?
Price action is trapped. We are at 163.042 with less than 20 pips of runway before the 5-day high of 163.23950 acts as a hard ceiling. Today's low was 162.994, confirming that bids are defending the lower band. Structurally, we are in a congestion zone. There is no momentum here. It's a tight range bound by the 50-day high. The tape is telling us that buyers are hesitant to chase above 163.2, and sellers haven't yet broken the 162.9 support.
And I'd argue that the technical resistance is secondary to the positioning reality. You're looking at a chart, I'm looking at a ledger. Leveraged funds are holding a net short position of negative 90,461 contracts on the yen. They added negative 91,732 contracts week over week. That is an extreme concentration of shorts when you have that much leverage stacked on one side. Technical resistance at 163.23950 becomes irrelevant. If yields stabilize, or if there's any hint of BOJ intervention, that wall of shorts forces mechanical buying. The chart doesn't matter when the margin calls start.
Which brings me to the risk in that crowded trade. Grid, you're focused on the breakout level, but you're ignoring the VIX regime. The VIX is at 17.05, giving traders a false sense of security to hold those yen shorts. If dollar-yen tests that 163.2395 high, the low volatility environment means any reversal will be violent, not gradual. The 14 out of 100 fear and greed score suggests the ground is shaky. A move higher in dollar-yen might trigger a rapid unwinding of those carry trades, catching the grid breakout traders off guard.
Fair point on the positioning, SPECTER, but let's look at the actual price action. The 5-day range from 162.20250 to 163.23950 shows repeated wicks rejecting higher prices. This isn't a smooth climb, it's a fight. If we don't get a confirmed close outside the 5-day high band, entering longs here offers poor risk-to-reward. The data suggests range-bound chop, not a trend continuation. Until we break 163.23950 with volume, I'm treating this as a fade.
Moving to euro-dollar. It's sitting at 1.1429, testing the mid-range of its 5-day high of 1.14496 and low of 1.13973. The pair is trying to find direction amid the ECB/Fed divergence. Pulse, is this a breakout or a fake-out?
Given the 3.46% US CPI and the ECB holding at 2.25%, the fundamental pressure is firmly against the euro. The improvement Lagarde cited is insufficient to close the interest rate gap. Unless the U.S. labor data deteriorates significantly, which the 187,000 jobless claims suggest is unlikely, The euro lacks the tailwind to sustainably break above 1.14496. The fundamental engine is pushing dollar higher, making any euro strength likely temporary relief for bears rather than a reversal.
I agree with the directional bias, but let's look at the flow. Unlike the yen shorts, the euro positioning isn't showing the same extreme crowding. However, the DXY itself is getting heavy lifting from leveraged funds, adding 4,438 net longs. That broad dollar strength is a tide that lifts all dollar boats. The euro is being dragged down not necessarily by specific euro selling, but by the overwhelming bid for the basket. The flow data confirms that capital is exiting EM and G10 FX in favor of pure dollar liquidity.
Let's shift to gold. It's trading at 4,124.62, near the top of its 5-day range, which peaks at 4,166.12. The Fear and Greed Index is at 14 out of 100. SPECTER, is this safe haven demand justified or exhausted?
Justified but fragile. The Fear and Greed Index at 14 out of 100 indicates that investors are actively pulling back from risk. When sentiment hits these levels, capital rotates out of beta assets and into stores of value. Gold is at 4,124.62, occupying the upper quartile of its range. This isn't euphoria, it's defensive accumulation. However, the risk flag here is the VIX. With the VIX at 17.05, implied volatility is low. If the geopolitical headline about Iran escalates unexpectedly, we could see a spike in volatility that tests the lower support levels. Right now, the bid is there, but the cushion beneath it is thinner than it looks.
Technically, the structure is intact. We are holding above the 5-day low of 3,982.57. The current price of 4,124.62 is well supported. Resistance is clearly defined at the 5-day high of 4,166.12. If we consolidate here without breaking that high, we risk a pullback to retest the mid-range. But as long as we hold above 4,112.14, the intraday low, we are respecting the bullish macro structure. The chart isn't lying, it's confirming the safe haven inflow.
Finally, let's look at cable. It's at 1.3389, down by 10 basis points, sitting in the lower third of its 5-day range, high 1.34813, low 1.33543. Interestingly, CIPHER, the COT data shows a flip here. What's happening?
That's the contrary on signal. While price action is weak, leveraged funds have aggressively flipped bullish, adding 29,099 contracts week over week to reach a net long of 28,541. This stands in stark contrast to the asset manager sector, which remains deeply bearish at negative 131,404 net. So, speculators are buying the dip, but institutions are still selling. The disconnect suggests that while smart money sees value near the 1.33543 low, the broader trend hasn't turned yet. It's a potential floor, but not a ceiling breaker.
From a technical standpoint, that net long positioning aligns with the support level. 1.33543 acted as the 5-day low, and we are currently hovering just above it. If cable rejects higher levels repeatedly, as seen by the failure to reclaim yesterday's high, 1.33543 becomes a critical test. If it breaks, we open up space downward. But the fact that speculative longs are accumulating here suggests that any break below that level would trigger a quick mean reversion. The market is waiting for a decisive move either above 1.34813 or below 1.33543.
So we have a spectrum of flows. Dollar strength driven by Fed/ECB divergence, gold holding safe haven bids under extreme fear, and pound attempting to find a bottom against heavy institutional selling. Apex tie this together.
The common thread is the stagflationary wedge. Pulse highlighted the CPI at 3.46%, clashing with GDP at 2.09%. This forces the Fed to hold at 3.63%, while the ECB stalls at 2.25%. That policy asymmetry is the engine driving the dollar long positions CIPHER noted. Grid correctly identified that euro-dollar and dollar-yen are compressing against their 5-day extremes because the market is waiting for confirmation that this wedge won't snap. SPECTER warning about the VIX being at 17.05 serves as the caution flag. The calm is deceptive. Until the FOMC on July 29 clarifies if 3.46% inflation is peaking, flows will remain biased toward the dollar and gold, leaving pound and euro to navigate the turbulence.
To summarize the key takeaways from this pre-market briefing. First, the dollar is structurally reinforced by sticky U.S. inflation and labor data, creating a favorable environment against the ECB-stalled euro. Second, gold is holding strong near 5-day highs driven by extreme fear and geopolitical tension, though low VIX readings warn of hidden volatility risks. Third, cable shows signs of speculative buying near support, but institutional pressure remains heavy, keeping the pair in a consolidation zone. Thank you for joining the ShadowQuant Forex edition. Tomorrow, keep an eye on any shifts in the Fear and Greed Index, and monitor the dollar-yen level at 163.23950 for potential breakout attempts. That wraps up this edition of ShadowQuant Forex edition. Stay tuned for the after-hours session where we will see how these calls play out. Until then, trade safe.